Hi everyone, and welcome back to BP News, where we review the most important financial and real estate stories of the past week. My name is Dave Meyer, and in addition to being a real estate investor for over 10 years, I am the Vice President of Data and Analytics here at BiggerPockets, which means I have the great pleasure of spending 5 to 10 minutes with you each week talking about the most important news impacting real estate investors. This week we have 3 stories for you, the first of which is some frustrating news about home sales coming from the National Association of Realtors. The second story is encouraging developments for the millions of Americans in mortgage forbearance. And lastly, of course, we cannot avoid the crypto crash last week that wiped out over $1 trillion in value. Before we get into any of this, please make sure to give us a thumbs up, subscribe to the BiggerPockets YouTube channel, turn on those notifications to make sure that you can stay informed on everything you need to know to be a great real estate investor. All right, let's jump into our 3 stories this week. First, NAR, the National Association of Realtors, reported home sales dropped for a 3rd straight month. That hurts. I think I speak for everyone in saying that we want more home selling, not less. Unfortunately, this news indicates that the bidding wars and rapidly accelerating home values that we've been seeing for the last couple of months are here to stay. Buried in their release was good news, however. Each month, they release a survey that basically is meant to understand how people feel about the housing market. And this month, there was an uptick in people who feel that is a good time to sell. That number went up from 61% to 67%, indicating maybe more people will be putting their homes on the market. If you combine that with the upcoming summer season, which traditionally sees more homes being listed for sale, there's some hope that on the horizon, some increased sales volume could be here. I really hope so, because while there are many factors impacting the trajectory of the housing market that I'm not going to fully delve into here today, but without inventory increasing in a significant way, housing affordability and this ravenous housing market that we are seeing right now, it's not likely to improve anytime soon. Luckily, our second story brings us some more uplifting news. The number of homeowners in mortgage forbearance continues to fall. As a quick reminder, forbearance is an arrangement between a borrower and a lender to temporarily delay or reduce payments. Borrowers still owe the same amount, but forbearance gives them some time to get back on their feet. According to the Mortgage Bankers Association, the percentage of all homeowners in forbearance is 4.22%, and that is down from 5.5% in January. Great news. Notably, Fannie Mae and Freddie Mac are actually reporting the lowest forbearance numbers of all, with only 2.2% in forbearance. And that's big news because those 2 giants own the vast majority of mortgages in the United States. However, on the other hand, portfolio loans and private securities have a much higher percent of forbearance. It's actually above 8%. All told, though, the estimated number of people in forbearance is down to about 2.1 million. And this is very, very welcome news and represents a really positive trend, particularly for the homeowners who are getting back on their feet and won't face losing their homes through foreclosure. It's honestly wonderful to see. It's also good news for the housing market in general, as there has been concern in the market as to what will happen when the foreclosure moratoriums that have been implemented at state and federal levels are lifted. And luckily, these declining forbearance rates that we're seeing reduce the risk of a foreclosure crisis and eliminates a lot of the fears people have about these worst case scenarios. After all other things being equal, if fewer people are in mortgage forbearance, the stronger the fundamentals of the housing market are. For our last story this week, we have to talk about the enormous cryptocurrency correction or crash or whatever you want to call it last week. As of this recording, the market cap of all cryptocurrencies, which means the total amount of money invested in cryptocurrencies, was down over $1 trillion since its peak, which is absolutely nuts. While it's not always easy to know what's moving the crypto markets, 2 major events seem to have caused the most recent sell-off. First was a crackdown on crypto mining and trading in China, and a tweet by Elon Musk stating that Tesla would not, in fact, be accepting Bitcoin as payment after all, citing environmental concerns related to the energy intensity of Bitcoin mining. With these events, the rapid run-up in prices in recent months, inflation fears mounting, and the very nature of the cryptocurrency market, it is not too surprising that we're seeing this high level of volatility right now. There's uncertainty all over the economy, and of course that's going to hit the crypto market particularly hard. For the true believers in crypto, though, this is just part of this roller coaster on the way to becoming a mainstream asset class. But on the other hand, you have skeptics saying that this is just an example of how quickly speculative investing can come crashing down. Either way, what happens next is unclear, and it's unlikely to be a smooth ride. We're likely to see a lot of volatility, even if it keeps going down or starts heading back up. For real estate investors, though, this crashing crypto prices shouldn't really impact the housing market or interest rates, at least in any way that I'm aware of. It is important, though, if you're an investor, to pay attention to what is happening in every sort of asset class. To be a well-informed investor and have a good strategy, you need to know what's going on in the economic world. And for example, you should take note when $1 trillion in wealth gets wiped off the table in just 1 week, like happened this past week. That's it for BP News this week. Thank you so much for joining us. If you have any comments or questions, ideas for future news for us to cover, please let us know in the comments below. I'm Dave Meyer with BiggerPockets, and I'll see you next time. Thanks.